Hey folks, welcome back to another Google update. Let's take a look at last week, which was pretty good. The stock rose from $87 to $92. Plus, I had a credit spread on Friday, the last day of last week, which expired out of the money. So that's some extra income, and overall, I've made over $6,000 just in option premiums. I was up $3,400 for the week, and you can see this large gain there was because of the stock price movement. So it's nice to be back in the black, and it looks like I am pretty much break even though I'm halfway through this challenge because this is for week 26. My annualized ROI is not doing very well. I guess it could be worse. I could be negative, but let's see what I can do for this week. So last week it closed at the top of this green candle here, which was expected. I had a call spread with the short leg at 95 and I sold a put at 87. In terms of this week, it's going to be a shorter week ending on the 20th, which is this blue line here. We're sitting right in between my last week's call and put strikes. So in terms of which direction Alphabet will likely head this week, the signs are pointing, at least in the short term, that the stock is going up because I have this green line and blue line. The green line is a 9-day moving average and the blue line is 21. So it looks like the green line is almost about to cross over above the blue line. And that will probably happen today or tomorrow, which would be a bullish signal. The other thing is looking at the past few days. You can see the bottom wicks of these candles are longer than the top. It means the stock started off somewhere in the middle, dropped down, and then bulls came in and pushed it back up. So sometime it closed higher than it started, sometime it closed lower than it started. You can see previously if you have a larger wick on the top side, the next day tends to be down. If you have a large wick on the bottom side, the next day tends to be up, and then so on. So we have 3 days where the bottom wicks are really long. By the end of this week, which is just 3 days away, I would expect the stock to close higher. And then finally, if I zoom out a bit here, you can see the stock is still in the middle of forming this U shape, and it hasn't really come up to the top yet. So my target for this stock is actually at around $95. So I'll probably still have a put at 87 and a call around 95. But I expect the premiums to be lower this week just because it's a shorter week. So let's take a look at the option chain. So at the 87 strike, I can make about $18, and then 95 is $12. So I'm going to put in a short strangle and have two quantities. It's not going to be a lot of money, but I'll see if there's opportunities to put in a spread later this week.
Order filled.
Okay, there we go. So it filled at 31, which is going to be $62 minus a couple dollars for a commission. And I'm actually pretty sure we're not going to go below this level right here, around $86, because that seems to be a pretty strong support line in the past. And right now we're all the way up here, so the stock will have to go down quite a lot to get there. So I'm actually going to do a put ratio spread over here, which means I'm going to make a little bit of money if the stock finishes above 86, and if it finishes around 86 or a little bit below, then I'll make a lot of money, and then if it's much lower than that, then that's when I'll start to lose money. So the idea is I'm going to buy one strike and I'm going to sell multiples of a lower strike. So for example, if I buy the 86 strike put, I will pay about $12, and then I will sell, let's say, the 85 put, and I'll sell two of them, so that'll make $14. So I'm paying $12 and getting $14. So it's a very small spread between. So maybe I won't go with 86, 85. I might choose like 85 and 84 and a half. And then I'll just say, instead of selling one 84 and a half, I'm going to sell two. So that with my spread, it's going to be a negative number here, which means I'm going to make a credit. You can see the delta is very low. It's only at 5%. And I'll probably set a quantity of around 6 or 7. Now, if I look at the profile, this is what it's going to look like. So my break even is going to be $84, which means as long as the stock does not go below there, which I don't think it will, then I should make money. And if it's around 84, but a little bit higher, let's say 84 and a half, which would be right around here, you can see I can make $363 because of that spike there. I'll talk about the ratio spread and how to do it in a separate video, but basically the most likely scenario is I'm going to make about $14. So that's assuming I get it filled at 4 cents, which will probably not be the case, but we'll see. Okay, so I'm going to drop this down to 3, so it's going to fill.
Autofilled.
Alright, so there's my ratio spread there. Quite a lot for a commission, but you can see that I have 7 times 3, or $21 minus 6. So that's $15 in premiums that I just made, and the chances of this losing money is only about 3.2% because $84 is my break even. And the stock today is at around $91. There's only 3 more days for the stock to drop to 84, which is not very likely. So I might make another trade during this week, depending on if any opportunities show up, but otherwise, I really do want to see Alphabet getting into another trading range like it had before. Like you can see, this trading range was very good because then I can sell more calls on the top and sell more puts when it gets to the bottom, and it's just more predictable that way. Right now, there is no range for Alphabet because it sort of broke out of that top range. It came down and now it's going back up. So this is why I'm comfortable selling more puts than selling calls, because it's more likely the stock will go to 95 first before it drops down to 87. So let's see how this goes. Thanks a lot for watching, and I'll give you another update next week.